All right, so the Fed finally did it. They cut interest rates, the move literally everyone was waiting for. But here's the weird thing. Instead of a big celebration, the markets are kind of full of uncertainty. So what's the deal? In this explainer, we're going to break down the Fed's super mixed signals and figure out what they mean for the economy, the markets, and yeah, your wallet.
Normally, a rate cut is a signal to pop the champagne, right? It means borrowing gets cheaper, it's a boost for the economy, it's supposed to be good news. So why the long faces? That's the big puzzle we're going to solve together today. Let's dig into the details and find out why this good news feels, well, so complicated.
Okay, first up, let's talk about the headline decision. Let's break down exactly what the Federal Reserve announced.
So here's the main event, a quarter-point rate cut. That's 25 basis points if you're speaking the language of Wall Street. This little move brings the Fed's key interest rate down into a new target range of 3.75% to 4.00%. Now, for anyone who needs a quick refresher, that key rate is the Fed funds rate. It's basically the interest rate banks charge each other for overnight loans. I know, it sounds super technical, but trust me, it's the main lever the Fed pulls to steer the entire U.S. economy. It ends up influencing everything from your mortgage rate to business loans. It's a big deal.
So why the cut and why now? Well, it all came down to a big surprise in the inflation numbers. The latest data showed inflation running at 3%, which was actually lower than what pretty much anyone was predicting. That unexpected cooldown was the green light the Fed needed to finally go ahead and make a cut.
But here's the thing with the Fed. The headline is never the whole story. And this is where it gets tricky, because along with that rate cut, they sent some really confusing signals. So let's try and decode them.
Fed Chair Powell was incredibly careful with his words. He pretty much immediately threw cold water on the idea that this was the beginning of a whole series of easy rate cuts. He said a cut in December was, and I'm quoting here, not a foregone conclusion. Now that was a crystal clear signal to the market. Hey, slow down, don't get ahead of yourselves.
And this slide really shows the balancing act the Fed is trying to pull off. The rate cut is like stepping on the gas pedal. It's meant to spur growth. But at the exact same time, they eased up on something called quantitative tightening. Just think of it this way. For the last year or so, the Fed's been pulling money out of the banking system to fight inflation. Now they're stopping that. Why? To make sure banks have plenty of cash and keep the financial system stable. It's a classic case of one foot on the gas, one foot on the brake.
So with all these mixed signals flying around, how did the market react? Let's take a quick look at the scorecard for the year so far.
You know, when you look at the market's performance this year, it's like it has a total split personality. It's fascinating. On one hand, you've got stocks, especially tech, just soaring, up over 17% and nearly 31% respectively. That's a huge bet on growth. But then you look over at gold, the classic thing you buy when you're nervous. It's up a massive 51%. This tells us that even as investors are chasing these big returns, there's a deep undercurrent of anxiety bubbling just beneath the surface.
And this chart, it tells a really interesting story about how investors are feeling. You see this huge gap between different parts of the market. High-growth tech stocks are flying high, up almost 31%. But consumer staples, the companies that sell stuff we need every day like toothpaste and snacks, they're only up about 4%. This huge difference tells you that investors are really chasing growth and taking on risk, not playing it safe.
So with the market in this kind of weird, tense spot, all eyes, and I mean all eyes, are now on the economic data that will help the Fed decide what to do in December and beyond.
So the next few days are absolutely critical. On Monday, we'll get a read on manufacturing. Are we making more stuff or less stuff? Then on Wednesday, the JOLTS report will tell us if companies are still hiring like crazy. And then Friday brings the main event, the jobs report. A strong report could mean the Fed decides to hold off on more cuts, while the weak one could signal that more help is needed.
Okay, so we've covered the decision, the signals, the market reaction, but let's bring it all home. What does this actually mean for you and your day-to-day life? So how does this all land in your world? Well, first, borrowing money just got a little cheaper. We're talking mortgages, car loans, and credit card rates. They're all nudged by this. Second, think of the Fed's actions like a thermometer for the economy's health. They're signaling they see a reason to give it a little nudge. Third, your 401k and other investments will definitely react to all this news. And finally, it's all connected to job security. The Fed is walking this tightrope, trying to cool off inflation without accidentally tipping the economy into a downturn that could impact jobs. Which brings us to our final thought. The Fed is cutting rates to give the economy a boost, but at the same time, it's telling us not to expect a lot more help. So the big question we're all left with is this: is the economy truly slowing down and in need of some support, or is it just, catching its breath before reaccelerating? The data this week is going to give us our next big clue.